edition of Targets in Focus, I'm joined by FX strategist Ankita Dudani from RBS in London. Ankita, I was speaking to another FX analyst earlier this morning about the current strength of the British pound. I understand you expect euro-pound to trade around current levels in the short term. Seeing as the UK economy has officially returned to a recession alongside the backdrop of the European debt crisis, what is your current outlook for the UK and Eurozone, and how does this reflect in your outlook for euro-pound going forward?
You mentioned the UK GDP number, but despite the soft print, it's impressive that rates in UK haven't moved much, and the interruption in the rally in sterling, especially against the euro, was only seen to be temporary. So, whilst it's important that UK has been weak and it has returned to a technical recession, but the key for euro sterling especially is that the euro area has been much weaker. So, because it's a relative trade here, and we think sterling is going to do better because UK does not because UK does good, but because Europe does even worse than UK. And also there have been three notable developments out of UK recently, and all of them have supported sterling, and I think they're going to be supportive of sterling going forward as well. So we think overall the probability of further easing in May and perhaps in the first half of this year is quite low, and we look for euro sterling to trade towards the 80 handle. But that said, beyond 80, I think it would be stretching medium to long term.
What about the euro versus the US dollar? The euro climbed to a 3-week high against the US dollar this week. The Federal Reserve didn't rule out QE3 on Wednesday, but did say it was sceptical that the costs would outweigh the benefits. What are your views on the Fed's most recent comments, and what about your forecast for the euro dollar over the next 12 months?
I think a euro dollar has been quite frustrating. It's been stuck in a 130, 135 range for the past 3 months, and I think one of the reasons here is there has been a reluctance between the outlook for the Fed and the ECB. So despite the inflation and unemployment developments in both the regions, the Fed and the ECB aren't dealing with them as you would normally expect them to be, which is what's limiting the downside in euro dollar. We think most of the ECB's LTRO money has been deployed, and there are risks that the focus will once again shift back to solvency issues. The macro data in eurozone, as we discussed, has been quite poor, and with weak growth, the weaker countries will struggle all the more to rein in their fiscal deficits. So there are increasing signs of fiscal fatigue even from the non-peripheral countries in the eurozone. There is a high risk that the ECB will be forced to do further easing, to probably cut more rates in the policy, and that could add more downside pressure in euro dollar. We look for euro dollar to trade towards 126 handle, and in the second half we think it will reverse, given the fiscal policy in the US will start to take more of a center stage, and the Fed will be reluctant to stay optimistic about the economy because fiscal tightening will have on the US economy.
The Reserve Bank of New Zealand kept its benchmark rate at 2.5% this week, and the Australian dollar New Zealand cross has also extended its recent rise. What are your short, mid and long-term projections for this pair, and why?
In terms of Aussie Kiwi, both the central banks have stepped up their... what was interesting in the RBNZ overnight was they raised their concern over the strength of the Kiwi dollar. But despite of that, we are skeptical that the RBNZ will cut rate to limit the gains in the currency, because in New Zealand the house prices are rising quite sharply, and then the capacity in the construction sector is also expected to close by the end of the year. So we think there's more risk that the RBNZ will start to raise rates by coming towards the year end. In terms of a forecast over the next 12 months, we think Kiwi will consistently outperform the Aussie, as there are more threats and more reasons for the RBA to cut rates than the RBNZ, and this will put further downside pressure in Aussie rate spread over the Kiwi.
Thank you very much for that insight into the FX market, Ankita. Now that's all for Targets in Focus today, but join me tomorrow for more editions. Goodbye for now.